Joining us now, Stifel chief economist Lindsey Piegza. I'm glad that that's the way it looks at this point in time, again, to Jay Powell. Do you remember the days of Mike Milken and Drexel, Lindsey? Do you remember when someone would have a high degree of confidence in whether you could arrange financing? You remember that? Do you have a high degree of confidence that we know exactly where we are in terms of inflation and rates right now?
No, and I think it's very telling that the Fed chairman did concede that it's likely to take longer for the committee to gain the confidence that inflation is back on a disinflationary trend, at the same time taking a rate hike off the table. But the concern is that the conversation really stops short, because while the committee may be willing to remain indefinitely on the sideline, what is the threshold for re-engagement should inflation continue to rise? So at what point is the Fed not just going to be patient for rate cuts, but actively seek firmer policy should inflation continue on this meaningful and persistent trend away from the 2% target? So the conversation really stops short, and I'm concerned that the Fed is not only failing to handicap, but feeling underprepared for that scenario that inflation does move in an opposite direction of what the Fed is anticipating.
And they're already doing sort of easing light. They're not, so they're proceeding with that. We went from the Fed giving the markets at least the idea of 6 or 7 rate cuts. We went from that to like 3, and then we heard, I don't know, we're not there yet, but we're closer, and it's definitely coming. Now it's like, well, we feel like we're restrictive and that this is going to work, but we're not really sure. We don't think we're going to need any hikes. But it reminds me, on the way in, if you really misunderestimated, and it's a great George Bush term, but if you really misunderestimated inflation on the way in, why couldn't the Fed have that same sort of mindset right now that could turn out to be wrong? That once again, they're underestimating the chances that inflation stays worse than they think.
Well, I think it's very clear that they already are. If we look at the summary of economic projections, now we didn't get one yesterday, but we do have the one from March. The Fed anticipated a much more benign level of inflation than we're seeing, than what's been realized. So clearly the expectation for even a reduced forecast of 3 rate cuts in 2024 is outdated at this point. So the Fed continuing to perpetuate this notion of patience, but it's going to be a rate cut as the next move, really underscores, I think, the Fed's inability to handicap some of these different scenarios should inflation continue to evolve in a manner that's opposite of what the Fed is anticipating. As we've seen since January, price pressures have not just stabilized, but most metrics have pushed higher, away from that 2% target. But again, the Fed is very optimistic that the next move will be a rate cut, seemingly ignoring the scenario that they may be forced to re-engage if that second part of the mandate fails to be met, meaning price stability.
I don't know how you can say with certainty that you've hit the terminal rate, whether 5 to 5.5 on federal funds, and yeah, that's just right to rein in what we need. I'm back to worrying that first I thought it was spending too much money, too much stimulus, too much, staying at zero. Then I thought it was just supply chain, sort of transitory, would be transitory in the end. We all saw the soft landing coming and inflation was looking pretty good. Now I'm back to thinking maybe there are too many dollars out there sloshing around, and maybe fiscally we're still priming the pump. We were priming the pump at a during, it was not a crisis when we were priming the pump. So now I'm back to thinking this could be something that's ingrained and not going to be easily wrung out.
Well, that is the concern. The longer that the Fed remains on the sideline and allows price pressures to remain above the target level, the more they do become ingrained into the economy. But to your point, the reason that the Fed raises rates, the intention is to slow the consumer, which by extension slows the economy and results in more benign inflation. But when we look at the latest consumer numbers, it's very clear that the consumer has not been meaningfully slowed, let alone has the Fed done enough to really kill the consumer in order to result in that slower demand side inflation. the vast majority of the reprieve that we've seen has been on the supply side. So really from variables outside of the Fed's purview. So when we look forward, when we talk about have we reached this terminal level, historically, the Fed has needed to raise rates above the previous peak in inflation. Historically, raise it significantly, in many cases, above that previous peak. So with the PCE, the core PCE peaking at 5.6%, the notion that reaching that bare minimum, that upper bound of 5.5% would be enough to quell price pressures, really, it speaks against the historical precedent
Lindsey,
of where we should have been.
We're running out of time, so we're going to get a jobs number. If we saw the GDP number, was, I don't know whether it's good. It's good in terms of inflation, but we like a strong GDP. But if we do see some moderation in some of these metrics, like in the jobs market, can we just assume that will have a positive effect on inflation expectations, or inflation could stay where it is, and we could still have the labor market, we could have unemployment rising, and that may not be linked to lower inflation? Then we're really screwed.
Well, and that's the biggest scenario. That's the worst case scenario that the Fed could face, is this stagflation scenario, where the economy continues to lose momentum. We've already gone from 5 to 3 down to 2% at the first quarter. If we continue to lose momentum from here, but the Fed continues to tolerate above target inflation, well, now you have this double whammy for the American public, suffering both the effects of a slower economy and the pressure of above target inflation. So that stagflation scenario is really the worst case, suggesting that the Fed has a small and limited window to aggressively tackle inflation while still against the backdrop of a solid, positively growing economy.
Do you think, and I'm asking Andrew this, do you think if you had to put all your money on this, and that, Lindsey, that would be a lot.
All your money. This is gun to the head kind of situation here.
Like a bet, and you need odds. You would still bet the next move is down, not up in rates? I don't know at this point. I honestly don't know.
I honestly would flip a coin.
Yeah. Lindsey, you would bet your mortgage the house, you got to make a bet. The next move is down for rates, or is it possible it could be? Because he told us yesterday that the bar is much higher for raising.
I think the Fed should raise rates further to ensure a return to price stability. But this is a committee very desperate to provide relief and maintain these positive economic conditions. So I do think that the Powell Fed is inclined to give us a rate cut as their next move.
So we're moving the
goal. But it may be that we're just not getting anything.
We're not getting anything.
No, but if you believe that the Powell ultimately just wants to lower rates,
then he just stays here.
Just stays.
And we're okay at 2.5, 3 for inflation. It's sort of like, okay, we'll accept that.
Well, remember, even if the Fed gives us 25 or 50 basis points of relief, that's not an implication of a continuing downward trend in rates. Okay. In fact, I would suggest that after a minimal retreat, the Fed goes back to the sidelines for an extended second round period of maintaining the current level. So the Fed is desperate to give us some relief, but after that, the Fed's hands may be tied if inflation isn't showing us meaningful improvement.